All right, part 3 to continue. So we said that the radio and the service, if sold separately and independently, would be $100 and $150 each. So how to allocate the $200 total revenue? We use the relative weight or percentage of the two parts in the total, 40% and 60%, to get the relative revenue, $80 and $120 respectively. So let's do the journal entries. Let's say, pay attention to the date. On October 30th, we received $200 cash, and none of the two parts have been fulfilled yet. So it's a liability, it's a deferred revenue, right? We kind of customer prepaid for stuff we have not delivered. So here we use deferred revenue. So debit, cash increased by 200. It's a liability because we have not earned it yet, so it's deferred revenue. So credit, liability increase, credit, deferred revenue, $200. The next day, when we deliver the radio itself, the radio kit, it fulfilled the part of the obligation to deliver the equipment. So we recognize the $80 revenue from our previous calculation. That's the revenue for the radio. So deferred revenue becomes revenue. So part of the deferred revenue, $80, is reduced. So that's a liability decrease, goes on debit to debit, deferred revenue, $80, credit sales revenue, $80, revenue increase on the credit side. If the cost of goods sold for the radio is $35, so we recognize that as an expense, kind of remove that from the inventory and put that into the expense. So debit, cost of goods sold, $35, credit inventory, $35. By the end of next month, we recognize 1 month service revenue. That's 1/12 of the 120 total service revenue for the 12 months. So that would be $10. So similarly, we decrease the deferred revenue by $10. So remove the liability. We also recognize revenue by $10. So revenue increase goes on credit side. So credit service revenue, $10. And lastly, we're going to look at multi-step income statement using a merchandiser as an example. So let's look at Walmart. Okay. So the steps are basically 1, 2, and 3, because we don't care that much about income tax expense in this class. So first we start from net sales because we have returns and allowances, right? So you have a gross sales minus the returns, sales returns minus the allowances, we get the net sales. The net sales subtract or minus cost of goods sold, we get gross profit. Gross profit minus those expenses. What are they? Selling expenses, general expense, and administrative expense. We get income from operations. Then we minus other expenses. We get income before income tax expense. Other expenses could be typically interest expense, for example. And as I just mentioned, we don't care that much about income tax expense. So those are basically 1, 2, and 3 steps. And here you have different numbers in millions for Walmart for those 3 years. So gross profit, income from operations, and then arrive at income before income tax expense. Gross profit analysis. the gross profit percent equals gross profit divided by net sales, right? So gross profit divided by net sales equals your gross profit percent. So for those 3 years for Walmart, if we plug in the numbers, it's rather stable, roughly, between 24.3% to 24.9%. That's the gross profit percent. All right, so finally, as I mentioned, this chapter is lighter. We have 4 assignment questions, and I have a link inside the weeks folder that you can click and do it right on Connect. The same 4 questions, just in a different platform directly on Connect. All right, good luck everyone.